Hello everyone, I hope everyone has a wonderful holiday. In the last lesson, we talked about investment appraisal. There are two ways of investment appraisal. One is discounted method and one is non-discounting method. Today, we are going to talk about the non-discounting method first. Particularly, it is called the payback period and the ARR. By the end of this lesson, students should be able to learn two more investment appraisal for non-discounted method, namely the payback period and the ARR. What is the non-discounting method? The discounting method is assuming that the money in the future will be equal to the money today. Two common techniques that used by the non-discounting method is the first called the payback period and the second one is the ARR, or it is the average rate of return. Okay, so first the payback period or the payback method. So this is the method that calculates how long it will take to take back the initial cost or initial investment for the machine or for the project. So for the payback method, it calculates how many years or in total, how many months it will take to take back the initial investment. It is a lot of the people are using this method because it's relatively easy and very straightforward. It is commonly used to measure whether a company will face a cash flow problem or not, especially the payback period is more beneficial if there is a specific project or equipment that will be easily become out of date. It is also very important for the business that have very limited amount of cash, or for example, they are borrowing debt to finance the project. Okay, so let's have a look at the example of the payback method. Let's just say your company is planning to buy a new machinery that could cost £500,000. You expect that for this machine, the first year it will bring you 100,000 for the sales, and the following 4 years it will bring you 150,000 for the revenue. However, there's some cost associated with the machine. So in the third year, there will be a £20,000 of maintenance cost. Year 4 will have a £30,000 of maintenance cost, and year 5 will be £50,000. Now the question for you is, using the payback method, how long would it take to repay the initial investment of 500,000? So let's have a look at this example. Today, which is assuming it's year 0, we are paying £500,000. So in the cash out, we have 500,000. And since we don't get anything in today, so the cash in is 0. So the net cash flow will be a negative 500,000. Remember, for the students in accounting or finance, when you see this parenthesis, then it is assuming a negative figure. Next, in the year 1, we will be having a revenue of £100,000. And then from the question, we see that year 1, there is no maintenance expenses. We don't need to pay to fix our machine because it's pretty new. So for the cash out is £0. Cash in is 100,000. So the net cash flow is 100,000. Similarly, for the year 2, we see the following year will generate a £150,000. So cash in for the year 2 is 150,000. Again, from the question, there is no maintenance cost in the year 2, so cash out is £0. So if we minus 150 minus 0, then the net cash flow that we get is £150,000 in year 2. In the year 3, there will be a 20,000 maintenance cost. So in here, cash out, we have to pay out £20,000. And again, we have 150,000 for the cash in for the year 3. So if we subtract 150,000 by 20,000, then we get a positive 130,000 pounds for year 3. Following the similar steps, year 4 we have a 30,000 pounds of maintenance costs. So for the cash out, it will be 30,000 pounds. For the cash in, it is going to be 150,000 pounds. And the net will be 150,000 pounds minus the 30,000 pounds. Therefore, we get a net of 120,000 pounds for the year 4. And for the last year, year 5, we have a 50,000 pounds maintenance cost. The maintenance cost usually is increasing because as your machine get older, then you need to fix them more frequently. So year 5, 50,000 pounds, cash in same, it will be 150,000 pounds. So if we subtract 150,000 by 50,000, we get a net cash flow of 100,000 pounds. Okay, so now we fill in all the numbers in this table. So what do we need to do with these numbers? What we need to do is to add up all of the net cash flow and see which year, how many years it will take for us to pay back the whole 500,000 pounds. So for the year 1, it's only going to be 100,000, definitely not enough. Year 2 is going to be 100,000 plus the 150,000 with a total of 250,000. Still not enough. Year 3, it will be 100,000 plus 150,000 plus the 130,000 from year 3, and the total will be 380,000. It's still less than 500,000. So we go for year 4, where we add up year 1, 100,000. Year 2, 150,000, year 3, 130,000, and then plus year 4, 120,000. And this one will add up to 500,000. Therefore, for the conclusion, it is that we need 4 years for us to get the initial investment back. In this case, most of the people will treat the money coming from the year 5 for this 100,000 is more like profit for investing in this project. Now, there is a bad news. In reality, the net cash flow from the years might not always add up to the initial cash flow outflow. So for example, in this example, we have a cash outflow of 500,000 for the investment. And then when we add up the net cash flow for the 4 years, it adds up to 500,000, which is the exact amount of the initial cash flow. However, in reality, what if we add up the last year's cash flow and we got 530,000 pounds? Then what shall we do? If we add up the cash flow in the last year and the number exceeds the initial investment, then in this case, we need to calculate the specific month of the payback. Next, we are going to look for an example to see how to calculate the specific years and months for the payback period. In this example, we have the machine A, which generates this amount of cash flow revenue, and for the maintenance, it will be 7,500 each for each of the year. And the initial investment for the machine A will be 750,000 pounds. As we have learned from the payback value, then we have to calculate each year to see which year we can pay back the initial investment. In this case, year 1 will generate a 142.5 thousand, and this number comes from 150,000 pounds cash in minus the 7,500 pounds cash outflow. For the year 2, the net cash flow will be 200,000 minus the 7,500. This is going to be a total of 192.5 thousand pounds. In year 1, 142.5 thousand is apparently smaller than 750,000, and in the year 2, we add up 142.5 thousand plus the 192.5 thousand. It will be equal to 335,000, still smaller than 750,000 pounds. In this case, we need to have a look at the year 3 net cash flow. The year 3 net cash flow can be obtained by the 260,000 cash inflow minus the 7,500 cash outflow, and the total will be 252.5 thousand. If we add up all the net cash flow from these 3 years, it's going to be 142.5 thousand plus 192.5 thousand plus 252.5 thousand, and the total is going to be 587.5. It's a lot closer, but not yet, so we need to calculate the net cash flow of year 4. Year 4 net cash flow can be obtained similarly as the cash inflow 260,000 minus the cash outflow of 7,500. Then this will give a net cash flow of 252.5 thousand. And again, if we try to add up the first year net cash flow, which is 142.5, plus the second year net cash flow, which is 192.5, plus the year 3, 252.5, and then plus the year 4, again, 252.5 thousand. Now it will give a number that is a total of 840,000. Now this 840,000 is a lot bigger than the initial investment of 750. So now year 3 is too small, year 4 is too big. So what shall we do now? In this case, we can draw a vague conclusion that it would take around 3 to 4 years for this project to pay back the initial investment. However, usually this kind of the vague conclusion is not very attractive to investor. So it will be better if we are able to calculate the month of the year. Before we move on to the next slide, please remember this number from the year 3 first, which is a total of net cash flow of 587.5 thousand. Okay, now we know that for this project, it will take longer than 3 years but shorter than 4 years. So what we're going to do is the initial investment of 750,000 minus the third year net cash flow, a total of 587.5 thousand. Then this should give us a total of 162.5 thousand. For the next step, we need to take this 162.5 thousand and we have to divide it with the net cash flow of the third year, which is the 252.5 thousand. Then this should give us a number of 0.644. Then we take this 0.644 and we multiply by 12 months. Then this should give us 7.728 months. In reality, you can further take this. So we now know it's 3 years, 7 months, 0.728. What you can do in reality is that you can take this 0.728 months and then we multiply by 30 to see exactly how many days we need to take to get back our initial investment. However, for the assessment of this course, you will only need to run up the number of months. In this case, if you get 7.728 or you get 7.1 month, you will round it up to 3.8 months. In this case, this 7.7 months will become 8 months. And again, let me repeat once again, is round up, not round off. So even though your answer gets 0.1 months, it will still round up to 8 months. So the conclusion is the payback period will take 3 years and 8 months. Generally, for the payback period, if the payback period is shorter, usually it's a better project because it means it has a less risk and they are able to pay the initial investment quicker. And in this way, you have a shorter time and faster to generate profit, and you can invest the rest of your money in some other projects. In this case, if we are going to compare 2 or more projects using payback period, the advantage is that, as you can see from the example, it's quite easy and straightforward to understand. And the second advantage is that it helps us to adjust the uncertainty whether the project is able to pay back the initial investment or not. And the third advantage is that it tells us that which project will able to pay back faster so that people or investor can invest the remaining money into a new project. Now, for the disadvantage of payback period is that payback period does not specifically tells how much is the profit from the project. So we need to calculate ourselves or find out from ourselves. The second disadvantage is that the payback method does not really consider the additional cash flow after the payback period. In our previous example, we pay back our project around 4 years. So the first project we pay back at year 4, the second project we pay back at 3 years and 8 months. However, what if year 5 or year 6 we have a negative cash flow? Then if we simply following payback method, then we do not take those cash flow into consideration. Lastly, by using the payback method, it has to assume that the cash flow are stable throughout the year. However, in reality, we all know that generally the revenue from the Christmas, which is December, are usually higher than the other months. For now, students should be able to understand what is a non-discounting investment appraisal method, and specifically for the payback method. Using the similar way of calculation from what we have from the machine A example a while ago, I would like to leave you with the practice to calculate the payback period of the machine B. After you get the answer, then please tell me which one is a better investment. As usual, you will save your answer in a PowerPoint format, submit the work into the StudySmart, and this will count as your attendance. I hope this practice exercise helped you to solidify your knowledge about the payback method. Once again, thank you so much for watching this video, and I will see you in the next one.